let me start with a few lines intro about you, and do correct me if I get something wrong, but I'm so excited to talk to you here today. So you're multiple times founder, you've exited, you have a CTO background. You've while doing that, you've founded Sigma Squared Society, which is the world's largest entrepreneurship community, focusing on impact, and is present in 30 countries. And then you've managed to also run several funds that you're doing right now, and I understand it collectively it's more than 3 billion assets under management, while still involved in.
That's just a board position I'm in, to quickly correct this, right? It's not something I've personally built, but yeah, I'm a board member of that company. I'm managing 3 billions of assets.
Awesome. So if nothing to add, that's a damn what an intro, and would love to tap your brain on how you do startup investing. When you started, why did you start it? What's your motivation behind it?
Yeah, it's a great question. I started super early in my early 20s, after my first company. And for me, it was just important to basically support the ecosystem and give back to, to basically those, supporting me. And that was my motivation. I wasn't motivated financially. We can, like I now have a proper investment strategy, and we can talk about that later. But back then I didn't. I pretty much invested all of my money in angel investments back then, which is also no longer the case, just because I felt, hey, when everyone starts doing that of the founders, how will the European ecosystem look like? Probably way better, right? Also, you probably know this from the US. There's heaps of people in the US who just made lots of money with ESOP and VSOP. It's very untypical in Europe. But in the US, like people talk about, I was a 100th employee at Google, and they've made quite a lot of money being that and doing that, right? Or I was a 50th employee at Uber, and all these guys start investing. And bottom line, you just end up with so many more investors. And what my kind of dream is, what I'm also currently working on with Ivor, is try to create an ecosystem where so many more people can kind of invest, right? And based on that, I said, well, then I need to do that too, and I need to support founders as well. So that kind of was the first reason. The second reason is I just love to work with young founders. In a couple of investments, I was the very first investor. We talked about the pitch deck and about the story, and there wasn't even a product build or anything. And that's just what I really, really enjoy. And that also obviously means a low valuation and potentially an incredibly high multiple on that, right? And that is also what I was quite lucky with, I would say, quite early on. And therefore, I decided at one point, okay, like I can then also, start reinvesting or doing this a little bit more institutionally. That's the funds you've mentioned, right? Where I'm also doing much more of what I could probably stem privately. And that is how I started, and now it's become a little bit more sophisticated, but pretty much it's still the same motivation driving me.
Interesting. But so your motivation is coming from wanting to give back, wanting to also connect with founders who have this energy and draw from that. That is a significant motivation for many. But like when it comes to purely wealth building and returns versus risk, where do you see startups as an asset class? Is it something that you think is for you better than others?
Yeah, first of all, I do believe that, because I think it's a market with very asymmetric information, and secondly, very low accessibility. And standard economic theory suggests, if you have very asymmetric information and very low accessibility, you can exploit that. I personally believe I have quite a huge information advantage, first of all, because like Sigma and like other communities I'm involved in, like there's lots of incredible founders who just come to me naturally, and like other people might not speak with them. To give one concrete example, there was one person, we literally worked on the pitch deck around January, February. And I went in super early. I said, I would like to be the first investor. Like, you can have my check straight away. And last October, I'm speaking about, we began in January. Last October, Also, the GitHub CEO went in, the Zoom founder went in, the Alexa founder went in, and then Google went in on 130 million valuation. Is that something anyone can do? To be very honest, as odd as it sounds and a little bit cocky maybe as well, but I think I've been just very lucky hanging out in those ecosystems and having these asymmetric information advantages. So I think those are helpful, and then that's the first part, and then the second part is accessibility. Great founders, in my experience, are always oversubscribed. So actually, you also need to offer something to them to kind of get access to the deal. And if your profile is not interesting enough, you will most likely not be able to kind of make it into that deal. And therefore, does it kind of work for everyone? I don't think so, to be very honest. Like, there's books out there that kind of tell you it would work for everyone, but I don't think it does. That's why I think initiatives like what you do at Bad Ideas are fantastic, because it kind of provides people with access that usually don't have the access, and that is great. And then additionally, you asked a question about what about wealth building? Well, I think what many people don't understand is that the quantity of investments you make strongly influence risk. If you have a larger quantity, you have less risk, and that is different in different markets. So if you look at real estate, for example, buying one house is not really risky. Buying 1,000 houses is definitely less risky, but you kind of are in for a market risk suddenly, which is the entire real estate market. And in startup investing, it's the same thing. Again, like, the risk is indirectly proportional to the quantity. So one startup investment is very, very risky. However, lots of startup investments are kind of like investing in the entire asset class of startups. And that is not necessarily less risky than investing in entire real estate. Depending on the economic environment, you could even argue in some situations that this is actually less risky than doing real estate if you have a right number of startup investments. And there's lots of empirical statistics, for example. So comparing a 300 deal portfolio to a 30 deal portfolio, you're actually way more likely to triple or quintupling your money, actually 80% more likely, empirically speaking. And if you do more than 30 startup investments, your risk of having no return at all is reduced from around 10% to basically zero, right? So if you have enough cash to kind of make enough investments, I would say 100 plus, then you're pretty much risk-free compared to just doing like one investment. And that's empirical data, right? That's not just looking at like stories and anecdotal evidence. So I personally believe startup investing, for anyone who has the access and who has the cash to kind of do over 100 investments over, let's say, a decade, so 10 a year, is a fantastic thing to do with tremendous returns. I have a way higher return than on my stocks with my startup investments. But again, lots of that is unrealized, and like let's wait a couple of years and kind of see what actually happens.
This is awesome. Thanks for sharing that. You
Pleasure.
mentioned doing, like, I wanted to ask you about what's then the actual strategy that you would suggest, but I suppose the strategy that you laid out or hinted on is based on the mistakes you've made over the years. So what have been those mistakes, and what have you evolved your strategy into?
Yeah. So it's really hard to tell. Some things I see as mistakes might also be the right thing to do right now, right? It's a very nebulous space. So for example, I love to invest in visionaries and people who are just incredibly bold super early on. And sometimes these guys are assholes and they treat you very badly as an investor, like all the employees and the company, just blows up. And is that something you can prevent? I think I can get definitely better at that, but that's just a risk you have to take. And I'm very risk seeking in that regard. And I have to say, sometimes, this is sometimes it's the right thing to just risk it. So in retrospect, I would say maybe a little bit, I would do this a little bit less and do a little bit more due diligence on kind of former employees, former co-founders, and so on. But in general, I still stick to the approach to kind of support incredibly weird, bold visionaries, right? You just have a crazy thing in mind that probably no one else believes in. Next to this, I also did some investments where it was purely about the financial incentive. And now that I, have a little bit more money on the side, I'm kind of asking myself also, was this really necessary? I'm kind of moving towards a strategy where I'm saying like, hey, I really wanna support people who have a strong mission. And sometimes, that's not green tech, and that's not it's totally not related to social impact, and I don't mind. I think also in artificial intelligence and like crazy tech innovations, you can be immensely vision driven and just bringing humanity forward, as a whole with the kind of technologies you're building. That is something I really enjoy. But if I have the feeling, okay, this company in the next 10 years will be worth $1 billion or whatever, and actually now the world is not a better place at all, I wouldn't probably do it anymore, right? And I've done a couple of investments where I would say, maybe this was purely also, monetarily driven, even though I've kind of set my heart on just supporting great founders. But it just happens, right? And I probably wouldn't do these kind of investments so much anymore. I think we live in a time where we can combine impact and financial return really, really well. So I think I'm still going to make an incredible multiple, maybe even a higher multiple by focusing on impact. And still, I have the feeling I'm doing something good for the planet, for the people living on it, and so on. And that's just a sweet spot I really, really enjoy. And I want to do more of that. And I think my biggest mistakes were that I was just purely driven by monetary circumstances. And that's sometimes hard to get out of your head. And lastly, obviously, I failed a couple of times with my investments, but I don't regret that because I think it's part of the game. If you're in there, you gotta have the guts to kind of write off the thing completely and be like, okay, probably that won't return anything. The return in angel investing usually comes from 10 to 20% of your portfolio companies, right? So that's something I think you just generally have to be in for.
Interesting. So return coming from 10% of your portfolio, but you never know which one.
Exactly. It's a typical power law distribution, right? In mathematics, you know different distributions, like from normal distributions to power law distributions. And the funny thing is, in power law, some of the things really scale, but you never know which ones. That depends, though. That's where another theory comes in, chaos theory. And in chaos theory, your data is so sensitive to initial conditions that basically, like one change in the 20th decimal place of a number will just lead to a drastically huge different result, right? And like that is, in my opinion, how startup investing is. Like chaos theory meets power law distributions, and that's kind of really tough to crack. I think all you can do as an investor is to, as you say, totally be okay that you don't know which 10% it will be, because they're so sensitive to initial condition. Similarly, we can't predict the weather, and we probably never will perfectly, and that's chaos theory. So in startups, like we can't perfectly predict which kind of companies will make it. That's just chaos theory. Like so many people have accepted this. And honestly, I don't get these investors who try to minimize all their risks and say, like, we want 100% of our portfolio companies to make a return. The craziest companies out there, Airbnb and so on, have all huge, objections from investors who say this will never work. That's why they're the best companies, right? Because they're doing something no one believes in. So I think you can never avoid this like 10-90% thing. It's just something that happens.
Fantastic. Coming back to the power law approach and theory, that would rule out the strategy of, hey, I want to be really picky, and this year I'll pick 1 or 2 investments to invest in, and they'll do great. Is that a strategy that you wouldn't do?
Yeah, it's super hard to say. So just to quickly recap, you're saying some years you're doing lots of investments, some years you
No,
just
no,
want to do
no.
a few.
I'm talking from the shoes of, hey, I'm
Yeah.
new to angel investing, haven't done this before. How do I go about? I have my budget. How much do I allocate? Do I invest one my favorite deal bigger amount, in the other smaller amounts? Do I be
Ah,
super picky? How big of a like regularity should I do for the year? So yeah, we can switch the topic to what would you
yeah.
suggest to a new angel investor?
Yeah. Great question. So first of all, right, my suggestion is like you need to reach a certain volume like of investments. Otherwise, it doesn't make too much sense. Secondly, um, should you invest more in companies you believe in most? It depends. It depends how well your judgment correlates with how well these, like these companies will actually be doing. There's lots of empirical evidence. For example, there's a fund at Stanford where they pretty much just give any Stanford student money, right? And they did lots of investments, but they declined, I think, 2. And both of them turned out to be unicorns. One of them was Snapchat. If you think about it, the idea of Snapchat is a little bit odd, right? So like they didn't get money, but essentially, the gist of this story is you never know. No matter how good you think you are in judging, it's like you don't know. And basically, what I'm tracking in my portfolio is, what would happen if I would invest always the same amount of money compared to what I've done before. And I've tracked in my own personal portfolio, which sounds horrible. I honestly have difficulty saying this, but if I would have invested the same amount of money, I would have made a little more money. It's actually
Oh.
suggesting, I think it's a statistical error. So I'm probably just as, but it's basically randomness. So
But
kind
it
of the
doesn't rule the
selection of
other
companies.
as well. So you shouldn't procrastinate over like one deal to invest more. Just you're making the case that at least it makes equal sense to be super disciplined, keep the same amount for each deal until you at least are maybe have the track record to evaluate.
Exactly. And that's just my portfolio. And then what I'm also kind of tracking at the moment is like confidence scores. So I'm kind of giving all of my investments, like they need to be a confidence score of 8 or higher. But that gives me kind of 3 levels of granularity, right? So they're either an 8, a 9, or a 10. And I'm kind of tracking at the moment. Are the 10s performing best or are the 8s performing best, right? And at the moment, the 10s are, they are performing really well. So I'm kind of tracking this for both my portfolio and my anti-portfolio. I'm also tracking the companies I'm not investing in to kind of see how they're doing and looking at returns. And there is a correlation with my confidence scores. So they're getting better now. And there's a suggestion that I'm kind of becoming a better decision maker. However, let's see how that develops over time. Let's maybe do another podcast in like 2 years from now, and then I can tell you more about my confidence scores and how they actually affected return. But I'm quite number driven and mathematical in that regard. And I think, yes, if you really know a lot, you can make better returns by investing a little bit more.
Daniel, final question on, you mentioned in the beginning, it matters it's asymmetry of information. How do you, as a new angel investor who might not have the vast network to tap into, how do you get access to great deals?
I mean, first of all, to talk to people like you, right, who have access already and just, like chip in a little bit of money. Secondly, to talk to lots of other angel investors who are already making deals and who can maybe let you in to some of their deals and you kind of start building rapport and like building a great network. I think still like 30% of my deals are just referred to me by like friendly angel investors who I know. And then you can look at, building a personal brand. That obviously really depends. That's something I haven't done. But you can build like your own website and do like lots of like posts about your investments. I think I've never posted about one of my investments, but if you start doing this, you will certainly have more people applying to you, and I think it would be quite effective. For me, I would not recommend it to someone who's kind of in my situation, because I'm also running a company and my personal brand currently is dedicated to that company. So I think, it might dilute. But if you are someone who now doesn't have their own company or has kind of a free personal brand that you can, like just channel into a certain way, I think that can be immensely powerful. My co-founder, for example, before he joined Ivor full-time, he was a full-time angel investor. And he kind of did over 60 angel investments, some of them outstanding returns. And he really developed a personal brand on LinkedIn where lots of like deal flow just comes from people following him on LinkedIn. So that can also be really, really effective. It's something you build over time. And lastly, I guess stuff like AngelList and so on, especially if you're new to the game, at least helps. There's probably way more. But first of all, we are running out of time. And secondly, I'm not thinking straight in terms of all of these categories, but I hope that gives at least a kind of good
really
overview of what is possible.
Yeah, thanks. This is really, really good.